Hi everyone, welcome to the Compounding Academy. In this breakdown, we're diving into one of the world's most dominant industrial businesses, Assa Abloy. If you've ever swiped a keycard at a hotel, walked through an automatic door, or locked your front door with a digital smart lock, chances are you've interacted with this company without even realizing it. What we're interested in today is why this business has compounded so successfully over time, and what could keep that going. We'll walk through the key drivers behind Assa Abloy's growth, the durability of its competitive advantages, and the financial traits that stand out to us as long-term investors. Before we get into Assa Abloy itself, let's zoom out and look at the broader backdrop. This is a market that's steadily evolving, driven by growing demands around security, smart automation, and sustainability. We think we're at a key inflection point where digital access, energy-efficient buildings, and the shift to smarter infrastructure are all converging, creating long-term tailwinds for companies that lead in this space. And that's exactly where Assa Abloy plays. Urbanization is reshaping how people live and work, with more buildings, more movement, and more need for secure access. At the same time, expectations for smarter, connected, and sustainable solutions are rising fast. Put it all together, and you get a long runway of structural growth in access solutions, one that's likely to play out over decades. Urbanization continues to accelerate, with 70% of the global population expected to live in cities by 2050. But many of those buildings are still using outdated access systems. Aging infrastructure is a major barrier to security and efficiency. Meanwhile, the smart lock market is booming, growing at 20% a year as demand for connected, intelligent solutions takes off. That demand is translating into real numbers. The global smart lock market is expected to grow from just over $2.8 billion today to $14.2 billion by 2033, a 20% annual growth rate. This kind of sustained expansion signals a clear long-term trend, not a passing fad. Now let's shift gears and look at the company leading this transformation. Assa Abloy is the global leader in access solutions, from traditional locks to cutting-edge smart systems, built around safety, sustainability, and scale. Assa Abloy has been shaping the access industry for nearly 3 decades. They're the global leader in locks and security doors. They're also pushing into smart access and digital security, helping buildings get smarter and safer. Through a steady stream of acquisitions, more than 300 since 1994, they've built out a global platform that blends traditional security with smart, digital, and sustainable access solutions. This slide captures what really drives durable compounding at Assa Abloy. First, market leadership. They hold over 30% share in a highly fragmented industry, more than 3 times the size of the next competitor. That scale advantage brings not just brand recognition, but also purchasing power and pricing leverage with their suppliers. Second, their localized manufacturing network gives them flexibility. Access regulations vary widely by country. Having local production means they can stay compliant, tailor solutions to specific markets, and reduce supply chain exposure. Third, strong brand. They're known for reliability, which matters in security. Products have long lifespans, and integration costs are high, both of which make customers stick around. And finally, pricing power. With high customer retention, long-term contracts, and premium positioning on many products, they're able to defend margins even in a rising cost environment. Assa Abloy's revenue growth has been impressively consistent over time, rising steadily with only a brief dip during the global pandemic. Management expects around 4% organic growth, with an additional 5% from acquisitions. But what really stands out here is the resilience of that growth through cycles. Structural demand plays a big role. Access solutions aren't discretionary. They're essential for safety and compliance. And because products like locks and doors wear out over time or need upgrading, there's a steady stream of replacement demand that keeps the revenue base sticky and dependable. It's that mix of necessity, regulation, and ongoing innovation that helps smooth the growth curve, even when the broader economy wobbles. Revenue growth has compounded at a steady 10.2% over the past 15 years. While it hasn't been flashy, the consistency is key. It provides a reliable foundation for compounding earnings per share in the high single digits. That stability is what enables total shareholder returns in the low teens, especially when paired with margin resilience and disciplined capital allocation. It's the kind of steady profile we look for in long-term compounders. Margins tell you a lot about a business. Here we see gross margins consistently above 40%, a clear sign of pricing power and cost efficiency. What stands out is the resilience during inflationary periods like 2022 to 2023, proof that Assa Abloy can pass on costs without eroding profitability. Stable operating margins around 16% also suggest disciplined execution, which supports reliable earnings growth year after year. One of our favourite metrics, ROIC, gives a window into capital efficiency. Assa Abloy's reported return on invested capital has hovered around 10 to 14% over the past decade. While not exceptional, it remains comfortably above its cost of capital, which supports value creation. What matters more here is return on tangible capital, consistently over 15%, which strips out goodwill from M&A and better reflects how efficiently the operating business redeploys capital. That's key in an acquisition-led model. Here we're looking at two key indicators of financial health: leverage and cash generation. The blue bars show net debt to EBITDA, which has crept up due to heavier M&A activity, but remains manageable at around 2.3x. More importantly, the red line shows free cash flow conversion. How much of net income is actually turned into cash? It's consistently above 100%, which supports reinvestment and gives management flexibility on capital allocation. Not the flashiest slide, but these two metrics tell you a lot about resilience and how sustainable the compounding story really is. Every compounding story comes with risks, and it's important to monitor a few key ones here. First, demand for access solutions can soften during periods of economic slowdown, particularly if construction activity stalls. Second, as the business becomes more digital, cybersecurity threats become more relevant. A high-profile breach could hurt trust in their smart solutions. Finally, given Assa Abloy's acquisition-heavy strategy, integration risk is real. Poor execution could erode margins or disrupt operations. There's also a strategic challenge. As the company grows, it becomes harder to move the needle. Smaller deals may have less impact on growth, and attractive targets may become harder to find. None of these are deal breakers, but they're worth watching. These are the KPIs worth keeping an eye on if you're tracking Assa Abloy's long-term performance. Organic revenue growth has historically come in around 4 to 5% through the cycle, supported by both replacement demand and increasing adoption of smarter access solutions. Acquisition growth adds a similar contribution, another 4 to 5%, though this can vary depending on deal activity. The combined top-line growth tends to be in the high single digits. Operating margins are also worth monitoring. They've been trending towards 16 to 17%, which is strong for an industrial company and a key enabler of consistent earnings growth and healthy returns on capital. Assa Abloy scores a 7.9 out of 10 on our business quality assessment, putting it firmly in high-quality territory. The radar chart breaks this down across 5 compounding pillars. Assa Abloy scores especially well on visibility and competitive strengths, thanks to consistent revenues and dominant market share. Its management effectiveness score also stands out, driven by solid margin expansion and a long track record of disciplined M&A execution. Financial strength is a touch lower due to headline ROIC, but that's partly a reflection of goodwill from acquisitions. If you look at tangible capital returns and free cash flow conversion, the underlying performance is stronger than it appears. Resilience is decent, though not outstanding, something to monitor in more challenging cycles. Overall, this score reflects a company with strong fundamentals and multiple levers to sustain long-term compounding. Assa Abloy sits at the heart of critical infrastructure. Demand for its products is deeply embedded, driven by security needs, regulation, and the steady push toward digital access. Revenues are both consistent and resilient, supported by brand loyalty, regular replacement cycles, and long-term service contracts. It's not flashy growth, but it's reliable. And that's exactly what we look for. All of that adds up to a high-quality business as reflected in the compounding pillars, the kind of company that gives you confidence in its ability to compound over time. If you'd like to dive deeper, you can download the full one-pager. Visit compounding-academy.com. It brings everything together, from financial metrics to competitive positioning, in a single snapshot. It also includes our quality score, which reflects our proprietary framework for assessing long-term compounders. And while we don't include valuation in these slides, to keep them timeless, we do update our valuation views regularly, and that's something we reserve for paid subscribers. If you enjoyed this overview, don't forget to subscribe for more concise takes on high-quality companies. Like and share if you found it useful. It really helps us grow. And for more deep dives, head over to compounding-academy.com.